Good morning, hello and welcome to ET Now's Buy Now, Sell Now with me, Varun Hiremath, and along with me, Karanya Rao. Let's now get a move on and check out the headlines this morning. There was a really strong US handover, so we'd like to begin off the show with that. The Dow was up 454 points, posting its best performance since July. It's now closing up to the Feb highs. Even if you look at the Nasdaq and the S&P, both closed at lifetime highs yesterday. For the Nasdaq, I'd say it's a little more important because, you know, traditional tech stocks which have just been powering like Tesla and Apple didn't really perform yesterday. But despite that, you saw all the headline benchmarks doing really well. So we were all expecting a major gap up opening here today, which didn't really happen. But with that being said, we are above 11,500 here domestically. And today for us, what's keeping the markets excited and upbeat is IT, Auto. They're really leading the rally. And then we have select stocks that are cooling off post their respective rallies. Now, coming on whether it's a good time to invest in the market or not, someone we at ET now follow very closely, Jefferies, is Chris Wood. He says the worst is over and you don't need to worry about lofty valuations. According to him, you can stay invested in India right now, and that's what he advises. Then switching gears a little bit to precious metals and gold, we'd like to highlight that for you this morning. The gold rally has been stellar. Daily turnover rallies to an 8-year high behind actual rallies in the precious metals. So that's something to take note of this morning. Then, of course, we have the AGR saga, which has been trending for the last couple of days now, ever since the Supreme Court came forward and said only 10 years. So it seems now that based on an ET Now exclusive, which is coming up shortly, they might have miscalculated the AGR dues. And sources say that the telcos are working on filing curative petitions in the Supreme Court, essentially trying to reverse the decision. So I'm talking about the liability, not the 10 years, but the quantum that is to be paid. Then moving forward, FM bankers meet today. Ruchi spoke about that earlier. One-time loan recast on the agenda. Credit guarantee scheme also under review. And finally, just one positive good news for the day to leave you with. Gloom is ebbing as far as electronic appliances go. Sales have surged 25 to 40% on a YOY basis. And those were the headlines for this morning. Over to you, Karanya.
Well, yes, too much happening as far as markets, policy and even consumption is concerned. So yes, lots to keep on your radar as far as the headlines concerned. But let's get you a big ET Now exclusive first. It may not be yet the end of the AGR fight. We believe, and what we're picking up from sources, is that telecom companies and their lawyers are likely to file for a curative petition. Let's take it across to Nayantara, who has more information about the story. Nayantara, over to you.
This is an ET Now exclusive where we're being told by our sources that lawyers, legal counsels, general counsels of VodafoneIdea as well as Bharti Airtel are preparing curative petitions to file at the Supreme Court on the AGR case. Big sums are we talking about. For VodafoneIdea, it's already more than 50,000 crore rupees at stake. So what will the curative petitions be filed on? What basis will they be filed on? We are being told by sources it's likely to be on the quantum. It's very right that anybody who files a curative petition finds the correct basis, one that's going to stand up in court simply because this is the last resort, literally. So the window of opportunity being sensed at, according to our sources by Bharti Airtel and VodafoneIdea, is on the quantum of AGR dues, where we understand that the companies feel the government has miscalculated AGR dues in a few circles. Now, when licenses have been given in the past in India, it's given in circle wise. So there are 22 circles. So if you, according to the companies, make a few mistakes in a few circles, it compounds over the years because you add interest, interest on interest, and then suddenly the sums become very, very large. And this is what we are understanding from our sources, that the miscalculation, because of which there has been compounding, could result in the companies saying that they owe far less than what the government has so far calculated. It's clearly a developing story. The AGR verdict had, of course, provided a 10-year time window for all the companies to pay the outstanding AGR dues. The government had wanted 20 years, but it seems from the timeline, it's the arguments that are going to be now argued in the Supreme Court, if at all the curative petitions are filed and admitted, will be on the quantum of dues.
Okay, thanks for that, Nayantara. So it seems that the telcos are putting up their own fight, and what they're saying is if you're going to give us only 10 years to pay, then maybe we should revisit the AGR calculations, which they believe are inflated. But on to another exclusive from ET now, and very important meet. The FM is going to meet the banks today. There's a one-time loan recast that needs to be discussed. There's a credit guarantee scheme under review. Policies need to be put in place to make sure that all this happens in an efficient manner. My colleague Ruchi is now with us to walk us through the fine print.
Finance Minister Nirmala Sitharaman will be holding an all-important meeting with banks as well as NBFCs. We're given to understand as she will be reviewing the progress of various schemes, including the emergency credit line guarantee scheme. Remember, the government had said that they will be offering 3 lakh crore rupee collateral-free loans to small and medium enterprises, and thereafter the government has also extended the scheme for business loans that were taken by individuals. Important to note that so far we have seen credit disbursements of close to 1 lakh crore rupees under the ECLGS, and the government is open to further widening of the emergency credit line guarantee scheme as well, and may look to include cooperative banks as well. Besides that, the finance minister will be reviewing the progress of the partial credit guarantee scheme as well as the credit guarantee scheme for subordinate debt as well. Important schemes that were announced by the government as a part of the wider Atmanirbhar Bharat package as well. The finance minister will also be reviewing the one-time restructuring scheme that was announced by the RBI, the kind of impact that has had on asset classification of various banks as well. Important to note that the RBI governor has already said that banks will have to preserve capital. They will have to look at getting more capital from the market, building buffers during these times. So will the banks once again raise the issue of more capital support by the government is something that we will have to wait and watch out for.
Thanks, Ruchi, for that. Meanwhile, let's get you how the market is doing. You have the benchmark indices in the green, but yes, largely, hovering around that flat line. The bias is definitely towards the gainers. You have Nifty gaining about 30 odd points. Sensex is up 60 points. But yeah, the broader markets once again back in action. You have small cap index gain close to 1.5%, and even the mid cap index is up 0.7%. Sectorally, barring some names from the Nifty Bank, Nifty PSU banks, as well as Nifty Metal, all the other sectoral indices are firmly in the green. You have Nifty IT up 1.6%, Nifty Media is up more than 1%. Pharma index is up 0.6%. Nifty Auto also is doing very well. It's gaining close to about 1% in trade. From the benchmarks, watch out for these gainers. Infratel up 5.5%, Grasim is up 4%. You have a Titan gaining quite smartly in trade, up 3.5%. In fact, the likes of UPL, Wipro, Eicher Motors, all of them are gaining in the excess of 3% each, and you only have a few losers in trade, and the quantum of loss there is nothing too significant, at least at this juncture. ICICI is down by about 1.5%. Hindalco is down 1%. Power Grid and Britannia also under pressure. Let me pull up some names from the small cap index just to give you a sense of who the top gainers are, who are the ones that are pulling the index higher. Bajaj Electricals up 4.5%. You have DCM Shriram up 4%. MCX is up nearly 4% as well. Navin Fluorine, Deepak Nitrates, Persistent, Metropolis. SpiceJet is also up 3% in trade. Avanti Feed is also gaining close to 3%. Just Dial, Tata Elexsi, Radico Khaitan, Dixon. These are essentially the top gainers that are lending a fair amount of support to the markets as we speak. Quickly pulling up the BNSN stock cloud as well, and the stocks that we are keeping on our watch list this morning. First up is a Rosari Bio. Some fund action took place. Plutus Wealth Management has bought close to 3 lakh shares in the company. You have some news coming in for IndusInd Bank. They will be issuing equity shares on a preferential basis to QIBs. They'll be allotting about 4.76 crore shares to raise about 2,500 crores. Next up is the Dish TV. They delivered their numbers last evening. They have actually turned around their bottom line, coming at 75 crores versus a loss of 35 crores of YOY. Margins have held up okay. Of course, there's been a massive compression there, but close to 50% levels. Revenue has come in at 835.5 crores. Next up, you have an Edelweiss in focus as well. Ontario Teachers has partnered with Edelweiss. They'll be investing about $350 million in the Indian private credit space. Concor, we spoke to them this morning. Some interesting and important management commentary coming in from there. So yes, very much in the limelight. Of course, on back of that divestment buzz as well, that has been a big overhang for quite some time and impending news. UBL, another stock that's gaining quite smartly in trade. You have, in fact, UBL jumping to the highest in 6 months. Quite a smart quite a smart up move seen there as far as UBL is concerned. You also have All Cargo. They'll be reviewing their due diligence report on share delisting proposal on Saturday. That's something we're picking up from agencies. And finally, an Intellect Design, another name from the broader end of the markets. They won a deal from Samba Financial Group. The news came by just about half an hour ago. The stock is also looking quite sharp in trade.
Okay, thanks for that, Karanya. But time to talk fundamentals and technicals with our two guests. We have Amar Singh and Saurabh Jain joining us this morning. Thank you for taking out the time to you both. Amar, let's come to you first. In terms of stocks today, what's catching your eye?
In terms of stocks, HDFC Life is one stock one can definitely look at this stock, because we've seen that the stock is really holding well, and the trend, if you look at the intermediate term trend as well as the long term trend, that is quite positive. So this is one stock one can look at from a trading perspective. Somewhere around 575, 585 levels can be used as a buying opportunity, with a stop loss of 553 and a target of 618 in the short term. And the second stock one can look at is from the IT space, and that's a bellwether stock, that's TCS. Because we've seen the stock really doing quite well, and today also the stock has witnessed a very sharp up move. So this is one stock. Technically, if you look at the charts, be it the weekly charts, monthly, or even the daily, we've seen some consolidation and then a pullback that's happening. So this is a stock which can be bought at the current levels with a stop loss of 2209 and a target of 2440 in the short term.
सौरभ है, अमर नहीं है ना? Okay, all right. Let's start off with the viewer queries. Let's start off with viewer queries as well. First up, we have a Twitter query coming in from Ravi. He wants to know the short as well as the long-term view on Tanla Solutions. Amar, could you come in on the technicals and what will be your call on this one?
Yeah, if we look at this stock, Tanla Solutions, it has witnessed a superb, you can say, a dream rally. Because over the last, since the start of June and till date, if you look at the stock has almost quadrupled. So it's gone up by more than 4 times. So the stock, and technically, if you look at the stock on the long-term charts, the stock continues to be extremely strong. But what we need to remember is that the stock has rallied from almost 50-odd levels to currently trade around 217 and had made a recent high of 250, 260 levels. So clearly shows that there's a lot of money has been made in this stock. So definitely one can look at booking profits. And technically, if you look on the daily charts, somewhere we are seeing that a topping out pattern could be there around 250, 260, which was the recent high. But the trend is in no ways, I would say, waning off. The uptrend still remains intact. So if those who wish to continue and hold, then the stop loss needs to be below 180 levels.
Do you track Tanla Solutions? Would you be able to give us some, idea about how the fundamentals are?
See, it is a very small IT company in the digital domain and cloud communication. It provides value-added services. But if you look at the operational performance, the business is not that consistent. I mean, you'll see that the margins go up and down. A few quarters back, it was in red. In last quarter, it reported profitability. There's a huge jump in the stock price considering the fact that the company is going to merge two subsidiaries, and that may give fill up to the overall revenue. So I'm not that optimistic. It is considering a small company with no consistency in the revenues and operations. I would rather recommend to go for a big size company like maybe HCL Technology, Mindtree, something like that.
Okay. So that was pretty clear. Look at a larger company. HCL Tech looks like a good alternative. Saurabh, great to have you back with us. We never got in your picks for this morning. So which stocks are catching your eye?
See, I'll be betting on the pharmaceutical and the IT industry. I have picked Alembic Pharmaceutical as a wealth creation idea. If you look at the company has grown, fivefold in the US market in the last 5 years. In the recent quarterly earnings, the company has, doubled its profitability. The company has been investing heavily in its business. Last year, they've invested approximately 1,500 crores in the investment, and they have flowed back approximately 14% of their revenue in the R&D. The company expects that the current expenditure, which has been the capex and the R&D expenditure the company is doing, they'll be able to reap more benefits out of that after FY22. Recently, they have done a QIP, out of which 400 crore would be repaid, would be used in the debt repayment, and about 350 crore will be used in expanding their API facility. So I'm quite optimistic about this, the future of this company and the operations. So there is a lot of pipeline with respect to the ANDA. They are filing approximately 25 ANDA per year. So I am expecting that this stock would do remarkably well. For 1 year target, we are keeping approximately 1150 rupees target for this stock.
Okay, thanks for that, Saurabh. Let's now get on to query 2, and it's a company we don't see too often, Steel Strips and Wheels. And I was just looking at the financials, 735 crore, small company. We have Nageshwar Rao writing to us, and he just wants to know short to long-term technical and fundamental views. So essentially, he wants to know from both ends, near-term and long-term. So let's come to the technical view first. What do you think? Does it, it's a small company, but it's a 30 PE stock, so it's definitely not cheap. On the chart, do you think that it's a good time to get in here?
Yeah, if you look at the stock is still trading at a discount of 70% from its all-time high in April 2018, when it had touched a high of almost 1473 levels. So currently it's around 470 odd levels. Technically, if you look at the stock definitely seems to have bottomed out, because somewhere or the other we are seeing a very strong base and support forming for the stock around 300-350 levels. So yes, the stock seems to have bottomed out, but technically if you look at it, somewhere around 510, 520, that's an immediate zone of resistance for the stock, because the stock did manage to somewhere recently touch those levels, but again correct from those levels. So 510, 520 is going to be an immediate level of resistance zone for the stock. Yes, if that is taken out, then the stock has a potential to spike or rally towards 600 odd levels. But if you look at the long-term charts, they still continue to be negative for this stock.
Okay, so Amar is not too optimistic from a long-term view. But let's see, fundamentally, Saurabh, it's expensive. With that being said, like Amar just pointed out, it is trading at a significant discount, and there's also about nearly 1,000 crores of debt, if I'm looking at the right number. So what do you think? Good time to get into Steel Strips and Wheels?
See, operationally, things are improving quite a bit for the Steel Strips company. I mean, the utilization rates are, back to the normal level. If you look at the August revenue figures that the company has given, they have shown approximately 15-20% kind of a growth with respect, if you compare it to the August 2019. They are seeing traction in passenger vehicles, two-wheeler, three-wheelers, and the tractor segment. Recently, they have got few orders from the US and Europe also. They have raised their guidance of approximately, they are seeing 14% year-on-year growth for the next 3 months. So in that sense, I think things are improving for this company. They are seeing quite a bit of traction in the Indian markets and the US market also. So in that sense, the kind of recovery we are seeing in the automobile, I'll put my bet on the steel strip. I'll say hold on to this stock.
Right, so a bit of a divergent view coming in there for steel strips. So if the viewer is watching us, he can take a call on the basis of what our experts had to say. Next up is an email query from Samir Singh. He's based out of Delhi. He wants us, or rather the experts, to suggest an entry level for IndiaMart. Amar, coming first to you on the technicals of IndiaMart, it's seen a dream run. I mean, ever since the stock has listed, look at the way it has grown, and in fact just hit a fresh lifetime high yesterday in trade. The stock right now is cooled off a tad, but really, given the way the chart has played itself out, what is a good entry point at the moment? Do you see any correction on the charts?
You rightly say that it's a dream run for the stock, because if you look at the stock over the last, I would say roughly around 7-8 weeks, the stock has rallied from almost 2,000. It's more than doubled, which is itself is a massive, I would say, up move. What we've seen in this stock over the last few trading sessions, barring yesterday, because that was a major move which had happened yesterday. So the stock was somewhat consolidating around 3,500 odd levels, wherein it was meeting with some resistance, and it had been trading around those levels. So now that becomes a very strong support for the stock. So, but not at the current levels, because the way the stock moved yesterday, I wouldn't say that one should go and enter at these levels, because one can get trapped. But yes, any dips definitely should be used as a buying opportunity. The stock now has immediate support somewhere, major support around 3,500-3,600 levels, and above that the support somewhere would be around the psychological 4,000 mark. So only on some correction one should enter the stock, otherwise one can be in for some surprise as well.
Okay, let's talk about fundamentals as well. Saurabh, we recently had a word with the management as well. They joined us on ET Now. They've told us about subscriber addition picking up in this quarter, and this is post the attrition that they saw in Q1. Also, the fact that this happened despite marketing spends coming down considerably, and it's partly due to a sharp uptick in the traffic to the platform in the recent months that has now been monetized to a great extent. Of course, it's also because of IndiaMart being a great substitute for the MSME markets as well. Talk to us about how you see the story playing out over the next few quarters or few years, perhaps, if you could give us some visibility there.
I think if you see few time back, or maybe few quarters back, few months back, nobody thought of that. Indians can do their business, their jobs sitting at home. The way the digitization has played out well for everybody, and everybody now has known that things can be done, businesses can be done in a more sophisticated manner without traveling and all. And through the platforms like IndiaMart provides, and the way the people have resorted to doing business, I think the things which have improved for this company would continue to go for long. I mean, this is the new normal, and the companies in this domain would continue to enjoy. So I'm quite optimistic on the business prospects, and view remains positive.
Okay, so that's a thumbs up for IndiaMart, although it has rallied tremendously, so maybe wait for a slightly better price to get in. But on that note, a big thank you to both our experts. Always great to get perspective. Time for a quick break here on Buy Now, Sell Now. Back with more shortly.
Welcome back. You're still watching Buy Now, Sell Now on ET Now. And apart from sharing his mantra on how to get rich, Mark Mobius also told us that India is now the top country to bet in his portfolio. His investments in India are focused essentially on infrastructure and medical space. Let's listen in to an excerpt of a conversation he had with us earlier in the day.
Because if you remember, I think last time we talked, India was third after China, Brazil, and then it was India. Now India is first, which speaks well for India and the tremendous performance we've had.
Which are the three stocks you own in India? I'll take my chances with that. I'm sure that our viewers would also like to know.
Well, I don't want to talk about individual stocks because I'm afraid that the people will think that they should be buying them. So I prefer not to. But you can go to the internet and check to Bloomberg what the Indian stocks we hold are. Let me say this. They are focused on the infrastructure area and also in the medical area. We're very interested in the medical sector. So those are the two areas that are very important for us.
Okay, that was Mark Mobius, but another very important investor is Chris Wood of Jefferies, and he writes a note weekly, and he's very focused on the Indian market. Vivek is going to walk us through the latest takeaways from his latest note.
Well, Chris Wood, in his latest interview in the Economic Times, has actually said and has given quite an important quote. He's saying that he will continue to stay invested as far as the Indian markets are concerned. He believes that the worst as far as the pandemic-induced lockdown, as well as in terms of equity market, he believes that the worst is over. What he also says is that as far as India is concerned, his understanding is that the net recovery rates are improving. And in fact, he believes, even though the caseload is something that continues to rise, and this is something that he has also written in his weekly newsletters, he believes that the death rate in India is really low. The market is probably taking the view, according to him, that the worst has been seen as far as India is concerned. He believes that the lockdown was something that is a bit of a misguided policy. He believes that the lockdown should have never been imposed in the first place, and the lockdown was quite negative as far as the Indian economy is concerned. What he is saying, as far as India is concerned, he would continue to stay invested in India. He believes that there are better markets to invest. However, he does not think that the markets will go back to the lows of March that the Indian markets witnessed. He believes that the government, which has not extended the moratorium, this is a bit of a positive move, and he believes that the restructuring process is much more positive as compared to having a moratorium extension. At this point of time, while he is not positive on Indian banks, he is a little less negative. Again, the most important thing to watch out for is his long-term view on gold. He is extremely bullish as far as gold is concerned. He believes that the fact that the US real interest rates are expected to remain quite low, and he believes while in the short term gold can correct a little bit more, he believes that there was going to be a long-term bull market as far as gold is concerned.
Okay, so Chris Woods Jeffries says stay invested, and he thinks that India still has a lot of value to offer. But switching gears a little bit, it seems that the Adani Group is planning to raise $1 billion via share sale. Now, if you're wondering why, it's because they want to acquire majority stake in the Mumbai airports, right? So they've already entered a deal to acquire the controlling interest in not just the current airport, but as well the new upcoming international airport, right? This is going to add to their portfolio of already 5 to 6 airports which they manage. And it's quite a quick scale up of this business considering they first entered this segment only fairly recently. It's been a couple years or so. So in order to finance this $1 billion, the transaction essentially, they're talking to investors. We've heard Qatar Investment Authority is one investor who's very avidly looking at the deal. There are 3 or 4 other big investors as well. Now, Qatar Investment is already partnering with Adani and Adani Electricity, and so there's already a strong relationship there. In order to raise this $1 billion, it seems that they might be willing to dilute up to 10 to 20% of their current airport holdings business for Qatar Investment to get an opportunity to enter. This will also add a lot of strategic value to their already existing businesses. And Mumbai is expected to become one of the largest air traffic hubs in India for sure, even in Asia, and then in the next 5 to 10 years, perhaps even in the world, in terms of what the air traffic projections are. So it's got this group in focus, which is currently in focus for almost every business that it operates, but nonetheless now looking like making a strong, formidable position in the airport business as well. Back to you, Karanya.
Right, let's turn to some more stocks to watch and trade. You had the Jubilant Foodworks numbers come out yesterday, and the stock did jump quite sharply after delivering a strong or rather a beat on most counts, and even the same-store sales growth came in quite high. Let's understand what exactly is the brokerage verdict, how are analysts digesting the fine print. Vinny is here to give us a lowdown on all that.
JP Morgan has maintained an overweight stance. They think that they are in the that Jubilant Food has all the right ingredients in the place, and overall the encouraging recovery trends which the company has mentioned about. So that is why they're very overweight on the stance, overweight on the stock, as well as Morgan Stanley also is overweight on the stock. They see that the company which reported obviously a positive EBITDA where we were expecting a loss. So that is a very positive sign, and recovery again for Morgan Stanley is also something that is pushing them towards the overweight stance. So both these brokerages are overweight on the company, and a decent set of numbers from Jubilant Foodworks as well.
In fact, let's also get you some highlights from the con call that they had last evening. This is what the management said.
We are hopeful that the business will continue to improve gradually over the next few months. We expect near normalcy by the exit of Q4 FY21. We remain excited about the medium to long-term potential of our category and our business, and we have no doubt that we will emerge from this crisis better positioned to participate in the opportunities that lie ahead.
Okay, coming back to markets, for all the traders out there, our technical chartist, Dr. C.K. Narayan, founder of Chart Advice, and Ashish Chaturmutta of Sanctum Wealth Management, have handpicked stocks for you to power your trades. Let's listen into excerpts of conversation we had with them earlier today.
I think the stock which I want to discuss today would be HDFC Asset Management Company. If you look at this stock, it has been consolidating for last couple of few weeks, as well as if you look at on the monthly chart also, it is a 5-month consolidation which has happened in HDFC Asset Management Company. If you look at from the weekly charts, what you can observe clearly is that stock is continuously trading above its 100-day moving average, and continuously it is trying to consolidate between your 20 as well as a 50-day moving average on a daily chart. So clearly it indicates that a lot of accumulation is taking place in the stock. In terms of momentum, that is missing because stock is still trading below its 100-day moving average, which is close to around 2500 mark. But the kind of pattern formation, it is clearly indicating that now that consolidation is coming to an end, and now 2350 is going to be a very, very strong support zone for the stock. And my sense is that the way this consolidation has happened on the 5-month basis, it is trying to create a kind of a triangle formation, and if this breakout about 2500 happens, then I'm expecting stock to hit somewhere close to around 2900 to 3000 kind of zone in next couple of few weeks.
Sure. I'm just looking at some of the key heavyweights, and perhaps that's what explains the kind of move that you're seeing on the index, which is unable to really rise up or see any meaningful gains. Look at Reliance Industries right now. CK, it's unable to hold on to key supports, currently lower roughly about 1%. What do you see on the near-term charts for RIL?
Well, RIL has been, quite a bit volatile. Of that, there is no doubt. The 21.65-75 range continues to act as a very strong supply zone for the stock, and now it's actually making a range on the lower end. So that's now between sale that has dropped down to about 21.40-45 range. So now rallies to that levels are meeting up with some sells. Now, this is not to mean that Reliance is slipping in its trend, but just that it has got into a range which is bounded on the downside at about 2080, and the top side is now a range between 2050 and 75. So market seems to be content playing in this range, awaiting some fresh news flow in that counter param. And so long as it is there, traders who are,
Let's move on and get you an excerpt from the Money Show as well in a bid to salute COVID warriors. My colleague Mubina had planned a special episode to, which was dedicated to planning the finances for doctors and nurses, how they should manage their money, how much amount should they keep in the emergency fund. We asked all of these questions to Harshvardhan Rungta. This is what he said.
With regards to specifically investments, the portfolio will not have anything different per se. Whenever you choose which asset to invest into, it's primarily dependent upon what are your goals, when do you want it eventually, what is the risk profile that you can take. So, the portfolio construction would essentially entail those parameters. So that we're not going to deviate from. But as you rightly said, the risk on their life currently is very high. So either there could be a situation wherein they can contract this contagious disease and fall ill themselves, or there could be a death. So in that case, what is paramount right now is definitely that you need to take care that you have an adequate insurance portfolio in place. So income and investing would be one part. Taking care of contingencies like falling ill yourself, or if unfortunately a person passes away. Now in that case, just ensure that you have adequate life cover in the form of a term plan. and you have adequate Mediclaim policy. So in case you were yourself to fall sick, just ensure that you get the treatment that you deserve, and don't fall short of money, at least in that context. So I guess insurance is something which needs a very, very deep look at this point in time.
Exactly. Insurance is something that's very, very important, especially for all of our COVID warriors. Now, health and, a basic life insurance, I'm sure, is very important. Harsh, do you recommend that, their life cover, their sum assured, that bit of, their overall financial portfolio should be more high? They should not cut corners over there that, okay, I do not want to pay so much premium, so, let me just cut down my sum assured. Do you think that bit, is absolutely uncompromisable?
Absolutely right. So in fact, if you look into investment portfolios and the insurance portfolios of many individuals, you will notice that, insurance is such a topic, people generally tend to stay away from it because they're so heckled already by people who are their relatives as agents and all that. So people usually prefer that, they don't like the subject of insurance. So if you talk to somebody and say that do you have adequate insurance? The answer comes out, yes, I have lots of insurance. You say, how much insurance do you have? So the answer comes is, I have 10 policies. You still have to ask, how much insurance do you have? So they say, I am paying an X amount, say 1 lakh or 2 lakh of rupees every year. The question is still not answered, how much insurance do you have? So the sum insured is actually what you need to look at. And in most cases, you will find that sum insured will not be adequate. So yes, answering that question, you will need to ensure that you do not cut corners with respect to insurance, be it life or be it health. I'll tell you another reason why. Being professionals, the source of income is when they render their professional service. It's a skilled labor. You can't visit a doctor's clinic when the doctor is not available. So if you are a doctor, there is a patient coming in to consult you. Now, if you are not going to be there, the income stops completely. You may have support staff, you may have compounders, you may have other people in your office, in your clinic, but nobody comes to consult them. So the clinic's income will stop completely in case you're not there. If the clinic income stops, your family income stops. So insurance for professionals is very, very essential, and you need to insure yourself to the maximum amount that you're eligible for. In case of life insurance, there is a maximum that you can get is a multiple of your income. So if you're earning an X income every year, based on your age, you will be eligible for an insurance which is 10, 15, 20 or 25 times of your income. So ensure that you take the maximum insurance that is eligible for. With regards to health insurance, the cost of medical treatment these days. You're a healthcare professional yourself. So you must insure yourself for a higher amount, and just ensure that the worst case scenario, you at least have 20 to 25 lakhs available in the form of an insurance per annum at least. So health insurance would be at least, say, 20 to 25 if you're in metros. If you're in smaller cities, of course, you can buy an insurance for a lesser amount, but more the better.
Okay, that was a pretty interesting excerpt. We have some more lined up for you. Before we go any further, let's just take stock of the numbers. The BARC data is out. It's Thursday. And once again, ET now has emerged as a #1 English business news channel in India. So a big thank you to all our viewers. We're now really starting to outrank the competition, 53% versus 47%. So, we've really stepped up our game during the last 3 or 4 months, whether it be the quality of guests or managements. And it's now starting to reflect in the numbers. So a big thank you again to all our viewers for making ET now India's #1 business news channel. With that being said, let's get a move on. And switching gears a bit to Silicon Valley, you may have read about Silicon Valley, San Francisco, reporting a whopping rise in empty homes as remote work allows more and more people to move to places that don't have a high cost of living, taxes, or virus risk. While India's Silicon Valley, Bengaluru, is nowhere as deserted as SFO, the number of empty spaces has been going up for the last few months as techies choose to rent homes outside the city. Chandra R. Shrikant finds out more on this trend in our special series, Rebooting Bangalore. Let's listen in.
Indranagar, Kuramangala and HSR layout are residential areas that became major startup hubs in Bengaluru over the last few years. Several working professionals live here in PGs, co-living facilities and independent houses on a rental basis. However, With work from home and remote working getting an extension by several companies, a large part of this population has moved back to their hometowns, thus vacating their rented places. As a result, unlike earlier, when the vacancy rate in these areas was almost nil, now there are several empty spaces, with to-let signs coming up in many parts of the city and listings for rented homes going up on property websites.
We've seen that in San Francisco, that the city center residential is getting vacated. So what's the reason for that? And perhaps we're seeing a similar trend in Bangalore city as well. So I would say it's 3 or 4 things, Chandra, on this one is, the first is this is a trend which is largely in IT cities. It's not a trend, for example, that we're seeing in Bombay. It's a trend that we are seeing in Bangalore. You have spotted out the trend very, very accurately. The second is that this is largely a culture where it is work from home. And then, Chandra, work from home means that work from anywhere. So many of these IT professionals have gone back to their hometowns itself. And they're working from home, from those hometowns, and have unleased the properties that they had leased. There's no point when they can work from home, and home could be anywhere. So why do you want to continue to remain in the city center when you're really not going to go to the office? The third trend, Chandra, we're seeing is that many of these lessees, the tenants, are taking properties on the periphery of the city. They're moving from inside the city to say, I would like property, residential property on the periphery of the city on rental. I want a larger home so that I can continue to work from home with convenience. And this is what we're seeing in San Francisco as well. And that's the reason. It's largely restricted to IT cities. It's where most of the companies are saying work from home. If work from home is back in a hometown, which is not their place of work, then they're going back to the hometown and hence de-leasing the residential property. Or, Chandra, really moving on the periphery, moving in the suburban areas of the city and saying is for the same rent that I was paying in the city center, I can get a property on the suburb, which will be much larger. And hence, I have a little bit more flexibility to move around, and I would have a little bit more office space for myself. And I don't need to commute because I don't need to go to the office every day.
Apart from Bengaluru, this trend is also expected to play out in cities such as Hyderabad and Pune, which has a significant number of tech workers. Analog Research estimates that vacancies in Indiranagar and Koramangala has gone up by 15 to 20%, while in HSR layout, it is up to 15%. In terms of rentals, there are negotiations happening at individual levels. The average residential rental for a standard 2 BHK house of 1,000 square feet area in these localities hover between Rs 20,000 to Rs 25,000 per month. As for PGs and co-living options, the monthly rentals for an individual are between 6,000 to 15,000 a month, depending on the facilities provided. But now, landlords in Indiranagar and Koramangala are willing to renegotiate and reduce rentals up to 15%, while in HSR, it is seen to be anywhere between 10 to 12%. Bangalore's infrastructure was already crumbling before the pandemic, besieged by poor roads, traffic jams, water supply, and garbage woes. With more techies renting homes in the peripheral areas after COVID-19, it remains to be seen if the center of gravity will move away from India's Silicon Valley. Chandra Ashrikant, ET Now.
Okay, welcome back to Buy Now, Sell Now. Earlier today, we caught up with market veteran Saurav Mukherjee. His picks have done so well recently, whether they be a Garware, a GMM, and alkylamines, all performing really well in this market. He suggests best bets to invest despite COVID. Let's listen in.
three sectors where I think we could see a multi-year strong rally. First is auto. We're seeing blistering numbers in the auto sector. Initially, I think we were all fearing that June, July could be a flash in the pan. But through August and now I'm hearing even through September, demand remains strong. And if cost of money stays low, and my reckoning is cost of money will actually go lower, therefore auto loans become even cheaper still, we could see a multi-year recovery in auto stocks. They've been pounded for 3 years. Typically, auto in our country goes through 6-7 good years, 3-4 bad years. We're sort of overdue a recovery, and maybe COVID was the trigger that the auto sector needed for a strong run. So I think that's one straightforward sector one should consider. If there's a Make in India angle, then so much the better. The second is the lending side of financials, right? We've been saying for the last 3 or 4 months that what COVID will do is it'll crunch the balance sheets. It will damage the balance sheets of most of the PSU banks, most NBFCs, and therefore it will trigger a massive consolidation in our both banks and our NBFC sector. Even the best banks in our country are still down 15-20% from January, February. And as we get out of morat, go through restructuring, once we reach the end of the fiscal, I think the weaker lenders will start getting crushed, and therefore we start seeing a multi-year rally in high quality financials. And the third sector is the whole play around APIs, chemical intermediates. I think there's a lot of private equity money heading towards that sector now. And if the tensions with China continue, India will have to bring a lot of API manufacturing from China to India. We are almost entirely dependent on China for our API. That's not sustainable from any perspective. And therefore, I think we're heading into a multi-year boom on API manufacturing and the entire ecosystem which feeds into API manufacturing.
Moving on to another ET Now exclusive with the more than 75% share of the country's rail container transport business, Concor is sure to be a huge beneficiary of the Atmanirbhar Bharat mission. ET Now's Aisha Faridi caught up with V. Kalyanarama. He's the CMD of Concor. To understand how Concor plans to use its expansive network to capitalize on the government's initiative and get an update on their much-awaited divestment.
The Atmanirbhar Bharat should increase our exports more. The export competitiveness of Indian products will increase with this Atmanirbhar Bharat. As on date, more of primary products get exported from India rather than manufactured products. But now things started looking up. We hear that some mobile manufacturing is starting in India and something is shifting from other countries to India. So this will definitely increase the exports. So when the exports increase, like as on date, even in the lockdown period, as I said, when we were continuously working, see, we could see around 80 to 90% of the demand of last year's level, even in this lockdown period. Even Unlock started, the Unlock 1 and 2 is not completely fully operational, manufacturing.
Okay, with that, we've come to the end of our segment here. Buy now, sell now. Thank you so much for tuning in. Keep it with ET Now for Markets at Noon coming up next.